Yet again, we begin with the latest bout of blatant price suppression and manipulation in the silver market. Silver didn't just fall. It was forced down. Late on Thursday, February 6th, 2026, silver collapsed over 21%, slicing clean through last Friday's crash low as if it didn't exist. That's not price discovery. That's a market under stress, where the most leveraged, the most fragile, and the most exposed positions are being systematically wiped out. When markets turn chaotic and dysfunctional, this is always how it starts. Not with the asset at the center of the storm, but with the ones that are easiest to break. And for the last several months, that structure has been silver. To further worsen the situation, the CME has quietly dropped a third margin hike in just 10 days, an 11% increase for gold futures, and a brutal 20% increase for silver, effective after the close on Friday, February 6th. Margin hikes are not neutral. They are weapons. They force liquidation, crush leverage, and flush out anyone who can't post more collateral, regardless of fundamentals. If you're wondering why silver looks like it's being executed rather than traded, this is why. And yet, while price is being smashed on the screen, something far more important is happening behind the scenes. Here's the part that should make you stop pretending this is just another volatile week. Yesterday alone, the COMEX accepted another 3 million ounces in silver delivery calls. That brings the total obligation to roughly 517 million ounces due for delivery over the next month. Let that sink in. They are obligated to deliver over 500 million ounces, and they have less than 120 million ounces registered and readily available. That isn't tight. That isn't uncomfortable. That is mathematically broken. Even after yesterday's engineered crash, all they managed to accomplish was a reduction of about 6,000 contracts in total open interest, bringing OI down to roughly 137,700 contracts. That's still the equivalent of 688 million ounces standing against a registered inventory of just 103 million ounces. And here's the key point the mainstream refuses to say out loud. The longs are not leaving. These aren't hot money speculators. These are players waiting for delivery. The open interest is still far too high relative to available metal, which tells you something critical. The crash didn't scare them away. It didn't solve the problem. It exposed it. Now fast forward just a few weeks. The March 2026 futures contract enters first delivery notice in about 3 weeks, and the CME has exactly 3 options. 1. They find an enormous amount of physical silver, fast 2. They let price rise violently until demand collapses and metal reappears 3. They declare some form of force majeure, declaring their inability to fuel the contracts. There is no 4th option. And every margin hike, every paper smash, every waterfall candle only accelerates physical demand, because artificially low prices in a shortage don't relieve pressure, they drain vaults faster. Which brings us to Asia. Today, the Shanghai Futures Exchange reported a huge drain in silver inventories, leaving just 350 tons, roughly 11.2 million ounces, remaining in SHFE vaults. That's not a rounding error. That's a flashing red warning. Asia isn't trading silver like a casino chip. It's treating it like a strategic material, and when price collapses under physical scarcity, the response isn't fear, it's withdrawal. The question now isn't whether silver is volatile. It's whether the paper architecture holding this market together can survive March. Because when leverage unwinds, inventories vanish, and margin hikes fail to flush out the longs, something has to give. And history tells us, it's never the metal. If you're holding physical silver, you already understand this isn't about daily price ticks. It's about who controls settlement when paper promises collide with real scarcity. Watch these next clips carefully. Listen not just for price targets, but for stress signals. Because when markets break, they don't send press releases. They send volatility. If you're stacking, comment below. Are these price drops shaking you or strengthening your conviction? And if you're new here, subscribe. We're not here for comfort. We're here for clarity, especially when the system starts to crack. We appreciate the support and hope you enjoy the video.
I still think you're going to several $100s on silver. It
Right.
wouldn't even shock me if you went to 500. Now that sounds ludicrous. Here's the logic behind that.
Right.
Silver range in arithmetic price was $4 to 50 for the last 50 years.
Uh-huh.
That's a tenfold move. Okay.
Right.
But if you do an arithmetic chart and you're an orthodox price guy, you
Mhm.
draw a rectangle and you take the rectangle distance and you add it to 50. Okay. If you take $4 to 50, you end up with something like mid-90s would be the swing objective, $45 swing. Well, look what happened several weeks ago. We stalled for a couple weeks in that 93 to 95 zone, where those guys were no doubt taking profits, thinking, oh, we reached the swing objective. Okay. You exploded through that and proved no, wasn't the swing objective. Okay. You went to 121, nothing to do. If you take the logarithmic scale, ratio price scale of silver, and you go from $4 to 50, let's call it 5 to 50.
Yeah.
That's a tenfold dimension move from bear low to bull high.
Right.
Tenfold above 50 is what? When you take a logarithmic scale and take the thickness of the range, and it says 500.
500. Yeah.
If you go back to 1980 high in silver and factor in the dollar's decay, you'll come up with something like that too.
No,
So it wouldn't shock me. And also, when markets get overly done one way or the other, silver overdone on the downside,
overdoes. Yeah.
it overshoots. Maybe it goes to a new reality, but it goes in excess and then pulls back to the new reality. So don't be shocked about what comes on the next, let's say by summer. The miners are vastly undervalued. We measure XAU index because it goes back to the 1980s, and we can go back far in measuring its relationship to gold. It's gold and silver miners versus gold. And we're now back below 8%, meaning divide XAU into gold. We were up above about 8.6% earlier this month. There is a range on the spread relationship between XAU and gold each month. Plotted what percent is XAU to gold. Between 5 and 8+% for 11 years. We probed up over the 8% a couple times, did this month as well. If you get a month that closes over the top of that range, like above 8.6%, okay, we're not there right now. We've tried. I think we'll get there. There is nothing on that chart. You go back to the 1980s and you'll see that XAU on average for decades was 25% the price of gold. On average, so it above and below there, with lows on that spread relationship over decades at 17 to 18%. You collapsed to 4% by 2015 in that bear market. The spread collapsed, meaning the miners devalued the gold, and they've lived with highs about 8%. If you broke out of that spread relationship and shot up even just to the bottom of that prior multi-decade relationship, you'd more than double the value of gold miners and silver miners to gold, just getting there. Wow. I expect it to happen.
What Michael Oliver is really saying here, once you strip away the shock value of 3-digit and 4-digit silver, is that this market is not operating on linear logic anymore. Silver is no longer a $20 to $50 metal stretching for upside. It's a compressed asset coming out of a 50-year base, where historical range expansion, dollar debasement, and prior inflation-adjusted highs all point to outcomes that feel absurd only because we've been conditioned to think small. His point isn't that $500 silver is guaranteed. It's that once a market breaks free from suppression, it overshoots first and rationalizes later. But that doesn't mean the path there is clean or comfortable. And that's where Gary Wagner's perspective becomes critical. Wagner pulls us out of long-term projection and drops us directly into the mechanics of the sell-off itself. Not fundamentals collapsing, not silver failing, but a technically overheated market meeting profit-taking, leverage, margin pressure, and institutional de-risking all at once. His analysis forces us to confront the reality that silver behaves like a candle burning at both ends. When it runs harder than gold, and when it corrects, it does so brutally. The key question now isn't whether silver's story is broken. It's whether this liquidation is ending, pausing, or simply resetting before the next leg.
Well, the first thing I think that's very important to realize is when we look at a price change over time in any commodity, we're looking at whether it's a fundamentally based move or a technically based move. In the case of the sell-off in gold and silver, I have to believe that fundamentally not that much has changed. We do have a new Fed chairman coming in, and so there's questions that are raised in terms of the uncertainty there. But all the fundamentals that move this market up continue to be in place. Inflation has been steady. It hasn't really gone down where we want it. When I say we, it's not me. The Fed's 2% target, we're still well above that. The economy is showing some signs of weakness. Of course, we didn't get the jobs report this week, so everybody's looking at the ADP report that came in well under estimate. So there's some concern about the labor market. Typically, what the Fed does to shore up labor is to cut rates. That should be good for gold, good for the precious metals, but yet we see them coming down.
Yeah.
And so that tells me that large institutional traders, some speculators, are taking money off the table. In other words, what we've witnessed is a market that has been extremely hot. When you compare gold to silver, I look at it as a candle that burns at both ends, burns twice as bright, but tends to go out quicker. And that's what we're seeing with silver. Silver has just literally fallen out of bed. When we look at, for example, price action on this one day, a 7% drop, the wrong day, 26% drop, $30 in a single day. And it went from an opening price of 115 and closed at 85. Then it fell further. We saw the same thing in gold. Here we had 2 days in which the market came back, and now it's back down. These lines are important for what we call technical views. Market technicians consider a market to be bullish if it's trading above the 50-day simple moving average, bearish if it's below. Silver is below. That is this dark blue line, and it is trading below the simple 50-day moving average. That's at 76.21. Silver is currently at 74.22. This bases the March futures contract.
Yeah, wow, look at that chart. I mean, let's talk about those candlesticks for a second. We see that massive, long lower shadow on today's candle. And I got to ask you, what's next? I mean, in your technical playbook, does a wick that long signal that this liquidation is finished and buyers have stepped in, or is it just kind of a dead cat bounce before lower lows?
Well, when you look at a candlestick, what you want to do is look at first the rectangle. The rectangle is color-coded in red or green. Red on this chart simply means it opened and then closed lower. Green means it opens and closes higher. In a bullish market, we want to see green candles, meaning it closes above its opening price. It's interesting in terms of the philosophy of a Japanese technical analysis in what they focus on. When I say that silver closed down $10 or $50, we know intrinsically what I've said is I've compared the close of yesterday to the close of today.
Yeah.
The importance that Western traders place on a close-to-close relationship is tantamount to one of the most important things. That's what they announce on the news. The Dow is up or down, and they're referring to close-to-close. To a Eastern technical trader, the most important information they can derive is, did the market close above or below the opening price? Because they view the market session really as a battle, and red tells you that the bearish faction was able to overwhelm the bullish faction, and the reverse with the green. So when you get these long green candles, long red candles, it means that there's tremendous selling pressure. Below that is what we call the wicks. And the wicks are the difference between the real body, the open and close, and the low and the high. Very small wick on this one brutal day. Kind of a long wick on the lower one, but the body size is so much larger than the wick where we have to focus on body size. So when I look at silver, I can see that towards the end of December, silver consolidated right around 70. You see these series of bottoms, whether they're green or red, and then it ran aggressively to the all-time record high. When it came down, these wicks have touched near this point, And the fact that it's below the 50-day moving average tells me that we could be seeing a pivot. I'm not convinced yet. I need to see multiple days and further declines. But I draw your attention to this one area, because the area of about $70, based on what happened at the end of December and beginning of January of this year, tells me that's where we want to look for potential support in the market. You can also see these wicks came very close. So this is the line in the sand in terms of whether or not what we're witnessing is a deep, but brutal sell-off that is really been instigated, implemented by traders taking money off the table, profit taking. Profit taking is different, obviously, than a fundamental shift. We haven't seen the fundamental shift. We have seen a technical sell-off.
What we're watching unfold right now is the collision between long-term repricing and short-term stress. On one side, you have the physical market, delivery pressure, shrinking vault inventories, Asian drawdowns, and a futures system increasingly misaligned with reality. On the other, you have leveraged paper positioning being forcibly unwound through margin hikes, technical breaks, and violent liquidation. These two forces don't cancel each other out. They compound. Every forced paper sell at artificially low prices accelerates physical demand, and every ounce removed from the system tightens the noose around future delivery obligations. That's why this drop feels different. Not because it's painless, it isn't, but because it's revealing. If this were a fundamental failure, we would see inventories rise, delivery requests fade, and open interest collapse. Instead, we're seeing the opposite. The longs are still there. The metal is still leaving. And the exchanges are responding not with confidence, but with higher margins and tighter rules. That's not strength. That's containment. From a technical standpoint, Gary Wagner is right to focus on structure. Moving averages, candlestick bodies, support zones around the low 70s. Markets need time to digest excess. They need consolidation after extremes. But zoom out just one level, and the implication becomes uncomfortable for the paper system, because technical damage can heal, but physical shortages cannot. Price can fall. Metal can't be printed. So where does that leave us as silver stackers? It leaves us exactly where conviction is tested, not at the highs, but in the chaos. Not when the narrative is clean, but when it's conflicting. This isn't about calling the bottom. It's about recognizing that volatility is not the enemy of a structurally broken market. It's the symptom. If you're watching this unfold in real time, ask yourself one honest question. Do you trust a price set by forced liquidation or by actual metal changing hands? If you found value in this breakdown, subscribe and stay with me. These next few weeks matter more than most people realize. And drop a comment below. Are you watching price or are you watching delivery? Because one of those tells the truth and the other just tells you what hurts today. Thanks for watching and hope to see you in the next one.